You are 24 years old. You have $8,000 saved. 2 doors in front of you. Behind the first one, the stock market, an index fund you can buy in 11 minutes on your phone. Behind the second one, real estate, a property, a mortgage, something tangible you can drive to. You can only walk through one door first, and the door you choose does not just change your portfolio. It changes your habits, your weekends, your psychology, and the version of yourself you become by 35. Door 1. You buy the index fund. Tuesday morning. Nothing ceremonial. You transfer $8,000 into a total market index fund and click confirm. That is it. The market drops 7% the next 3 weeks. You watch $560 disappear quietly. You do not sell. That non-decision is the most valuable thing you do all year. By 27, you have $31,000 in the market. You did not feel yourself accumulating it. Your weekends are yours. You move cities twice for career opportunities without an asset anchoring you anywhere. Your flexibility is intact. The machine runs without your attention. What stocks give you is permission to be imperfect. Invest $50 on a random Wednesday if that is all you have. The machine accepts everything and runs without you. But the ceiling in your 20s is patience. You have no mechanism to accelerate beyond adding more money and waiting. Patience is free and finite and harder than it sounds. Door 2. You buy the property. 11 more months of saving aggressively. Now you have $31,000. You find a duplex for $247,000. 1 unit rents for $1,050 a month. You run the numbers 40 times. You close. You are a landlord at 25 with $1,100 left in checking, and a tenant 3 weeks late on rent in month 1. The HVAC breaks in August. $2,800. You put it on a card. You learn what a plumber costs versus what a YouTube video costs. You learn that a good tenant is worth more than slightly higher rent from an unknown one. Real experience teaching real lessons in the expensive way experience always teaches. By 28, you refinance, pulling $18,000 in equity out as a down payment on a second property. You now control $445,000 in assets with $84,000 of your own equity. The bank funds the rest while you capture the appreciation. When values rise 7%, your equity grows by a multiple of that, because appreciation applies to the full asset value, not just your down payment. This is leverage. This is what stocks cannot offer you. At 30, both versions of you have similar net worths. Stock investor has $67,000 liquid. Real estate investor has $84,000 in equity, plus 2 properties producing $590 a month. Real estate investor slightly ahead in net worth. Stock investor significantly ahead in freedom and liquidity. By 35, the gap is real. Stock investor with steady contributions has $160,000 in the market. Real estate investor with 3 properties has $310,000 in equity, plus $1,400 a month in cash flow. The leverage compounded. But the stock investor moved cities twice for opportunities, adding $40,000 annually. Freedom. Generated income. Income-generated investment. Not a gap, a different shape. Here is the honest answer. If you're disciplined and emotionally consistent, stocks compound your life quietly with minimal friction. If you are action-oriented and willing to learn a craft and tolerate complexity, real estate rewards you at a rate that reflects the work you put in. Both paths punish the person who wants the outcome without the commitment. Both reward the person who commits and stays. The door you choose does not determine your outcome. Your relationship with discomfort does. Your ability to sit with a red screen for 14 months. Your ability to take a 2 a.m. call about a faucet you did not one to be responsible for at this hour. You already know what kind of person you are. Walk through the door that matches that person. Subscribe. More honest conversations about money are coming, and you do not want to miss them.